Hi, welcome to a special summer edition of A Short Story on Zeros TV. I'm Carson Block of Muddy Waters Capital, and I'm joined today by Edwin Dorsey. Edwin Dorsey has been around the short world a long time, publishing an activist short thesis on care.com while he was still a student at Stanford. Today, he has a popular newsletter with short ideas that he publishes on Substack called The Bear Cave. Today, Edwin and I are going to be talking about the recent civil charges and indictment of Andrew Left. And Edwin recently wrote a great piece on this titled In Defense of Andrew Left. So with that, Edwin, what do you think here? What's your reaction to the government's complaints against Andrew?
Carson, thanks so much for having me on. I'm really excited to be here, especially with you. Uh, I obviously think it's incredibly flawed. There's a lot of deficiencies in this case. To me, it seems like the government really doesn't understand activist short selling in general. They seem to be going after the wrong bad actors, and we can dive into that a little bit. They don't understand the nature of trading around reports. It seems like, what Andrew did here is more or less a victimless crime, given that a lot of his recommendations made money. I think there's a big slippery slope and follow-on effects from a lot of the actions that haven't been really explored or fleshed out by the government that we can talk about on this podcast. I think it's really, really flawed, and maybe a good place to start, and where I started with my article in defense of Andrew Left on Substack, is the commentary in the DOJ indictment against Andrew Left around trading in GE stock, where the government claims, and just to quote directly from the indictment, page 27, the government said Andrew Left, quote, initiated a media campaign to discredit another activist short seller's short report on GE and artificially inflate the price of GE stock to benefit defendants' Left's trading positions. And this seems to be kind of what a lot of the indictment talks about, Andrew Left making a short-term trade and making money after releasing commentary on a stock. In this case, to me, they get it totally backwards. Because what happened back in August 2019 is this whistleblower, Harry Markopoulos, released a very, very inflammatory report on GE. He registered the domain gefraud.com. He made a 175-page report and called GE a bigger fraud than Enron. He said GE was on the verge of insolvency. He goes on CNBC in the media circuit. And, he's very, very much trying to get a big single day move. And it works. The stock falls 12% in a day. Of course, the claims of this report largely weren't true. GE stock, even though he called it a bigger fraud than Enron, has now quadrupled. None of his claims really came to pass. But the government, instead of going after Harry Markopoulos, who was working with an anonymous hedge fund to be a balance sheet partner and make short-term trades around causing GE stock to fall, they got upset at Andrew Left for calling all the allegations meritless and disingenuous and making a short-term profitable trade intraday, making money when the stock goes up. Even though Andrew Left didn't appear to make any false claims about GE, Andrew Left made $50,000 or $70,000 in the course of a few hours. And it's bizarre to me. The DOJ is essentially saying you can work with an anonymous hedge fund, make sensational, baseless claims, make a huge single day stock move, get paid by an anonymous hedge fund, and that's all fine. But if you're Andrew Left and you go long the stock and sell within 4 hours, and even if you're completely right, that's a crime somehow. And that's just how so backwards so many parts of this indictment are to me, that when you dive in, just a lot of it doesn't make sense.
Yeah, look, I agree with you in part there and also disagree with you in part. The issue, so the GE Capital allegations by the government, the GE allegations by the government are a little strange to me because the entire complaint and indictment is the underlying issue is the government is saying, hey, Andrew makes statements that he doesn't have a good faith belief in. So, opinions are generally protected or entitled to a strong degree of protection under the First Amendment. But if you don't actually believe what you're saying, even though it's an opinion, and that's always really hard to prove. That's the basis of fraud claims, whether we're talking about in the markets or outside the market. Now, the
Yeah.
GE issue is kind of strange because the statements that the government is picking on there, when Andrew went long and said Markopoulos, is off base. I mean, Andrew focused on the fact that Markopoulos had a balance sheet provider, and which Markopoulos expressly disclosed in the disclaimer that he himself wasn't short. He had a balance sheet provider, and then Andrew said Citron finds that this is the worst behavior of activist short selling. We will never take payment from the fund for publishing. And it was, I honestly, to this day, at the time he published it, and then to this day, I don't know what he was thinking when he wrote that part, because number one, it's just not germane to whether Markopoulos is correct or not, or whether GE is, a buy, a sell, or what have you. But the government in that case is saying, hey, you lied, because just 18 months earlier, a hedge fund called Anson had paid you, I think, $1.1 million for in your share of profits for a couple of names that you published on, that they traded. So that one is the government saying, yeah, this is, you lied there. Now, you go to this question, and this is a theme throughout the government's claims, is that government tries to make this case that, hey, Andrew was always holding himself out as some expert that he wasn't really. And most of the rest of the indictment and complaint, when they're making that point, they focus on Citron Capital. So Andrew had set up an entity. He put his money in it. He had the track record audited. He had a slide deck, I believe, and he issued investor letters. Now, this part that runs throughout, again, the indictment and the SEC complaint just also strikes me as bizarre, because they're making the argument that Andrew tried to gain following and gain credibility by falsely holding himself out as a hedge fund manager. And my understanding of what happened was that Andrew tried to raise a fund. So, and he took his personal money, he put it in there, and there was an audited track record, and he was pitching clients. And the fact that he didn't succeed in getting money into that fund, well, he actually got a large separately managed account. I think you touched on this, right? He had an SMA for Atom LP. And, okay, that makes him an investment manager. But this idea, so with GE, and also with, his discussions of Citron Capital and the investor letters, which you write that for marketing purposes. They're going after statements that they say are false, but designed to give him credibility, as opposed to most of the rest of the case. They're going after statements that they say are not good faith statements or honestly held opinions about the values of the stocks that he's been publishing on.
Yeah, absolutely. Like, just to give the exact quotes here on Citron Capital, the DOJ indictment said he established Citron Capital, quote, to advance the false pretense that he successfully managed third-party investor funds and was a credible investment advisor. And kind of like you touch on one, that doesn't seem to be the case at all. You or I know Andrew Left. He's known for exposing frauds and having a very, very long history of exposing frauds and being instrumental in taking down Valiant and Malin fraud and a lot in China. So the idea that I think anybody viewed Citron Capital as bolstering Andrew's reputation, I don't really follow that. And then, he did manage third-party funds. Who cares if it's in Citron Capital or an SMA? So it's, again, just a point in the indictment that, just without even hearing the other side, just Googling in the public record, it really doesn't make sense. And to give an example, Carson, of how slippery a slope I think it can be on whether anybody's views are sincerely held, I went back in time a little and I looked at a 2013 article about Dan Loeb and Herbalife. And Herbalife was, a very controversial name at the time. Bill Ackman was short, Carl Icahn, Dan Loeb goes long. And in a January 9th, 2013 letter, Dan Loeb said he had bought Herbalife stock. He said it was a compelling long-term investment in the investor letter. And even though the stock was at $38, he put a price target in his investor letter for Herbalife of $55 to $68 a share. This is Dan Loeb, third point, reputable guy. And then 16 days later, he sells the shares at $44. And this seems to be the exact type of behavior the SEC is just trying to get Andrew on, which is giving a price target, selling before that price target is reached. And in theory, it's disingenuous. And I think you could make an argument if you say, hey, Herbalife is a compelling long-term investment, and you sell 16 days later, not even near the price target you gave, just according to the SEC and DOJ's logic, that is extremely problematic behavior, even though that seems to happen a lot on Wall Street. And
Yeah. Yeah. I mean, well, this gets into this whole realm of sell side research and price targets there. And I do want to delve into that, but in a moment. But I think what you bring up also creates this larger, there's a larger picture here, right? Which is, if you and I are sitting around bullshitting and we're talking about Herbalife stock, okay, I could say, look, man, I think it goes $55 to $60 in the next 12 months. Okay, but when you have a finite amount of capital, okay, like whatever it is, you have opportunity costs of using that capital, you have risk tolerances that are high or low, and you're dealing with this dynamic situation of the market. Okay, that's entirely different from saying, I think this is what, this is where it'll go, to this is how I will position in it, and I'm willing to hold only this much for this period of time. And if I start seeing XYZ in the market, that's going to impact how I think about it. If I'm getting redemptions from my fund, that's how I have to make allowances for that. If I come up with some compelling new opportunity, that's going to be a call on my capital. So these discussions in the complaint and indictment, really ignore that there's a much larger context in which money is actually invested. You would be unsophisticated and frankly reckless if you just invested according to this, your view of like, this is what I think it's worth. You have to take everything else into account. And it's just, it's looking at what Andrew does, each one of these trades in isolation from that. But, if I'd like to get into the whole thing about, these price targets and the sell side. And this is, this is one of the things that, okay, so when you're in the business that we're in, all right, you have a cynical view of the market. Like, you think things are broken. You think like there's so many bad actors out there. And at least my view is the vast majority of the time, the bad guys get away with it. Mediocrity and laziness are massively remunerated. Just a lot of dysfunction. And when we look at the sell side, okay, there are academic studies out there. They all, they're always way too positive on stocks in terms of buy recommendations versus sell recommendations. And we all know that sell recommendation is a very rare unicorn. They'll call it a hold instead. And, price targets are effectively arbitrary. Well, I need to put a buy on the stock because I don't want, as a sell side analyst, I'm going to catch shit if I don't have enough buys on stocks because, hey, I'm a cost center at my bank, right? Nobody makes money off of me. So it's basically, we need to make sure we're in there for investment banking deals. And also I keep an open line to management because as far as institutional clients or sales and trading clients are concerned, my value add is not my cognition. It's basically that I'm a dating service between institutional investors and managements. So I need to speak positively about these companies or else I fail in both of those missions. Now, if I'm going to say buy, I have to, have a target price that's above the current price. And, these guys will back solve for that. And you see this all the
Yes.
time. Like there's a target price, market rip, stock hits the target price. Well, miraculously, the target price goes up and it goes up. And what's the real reason you're raising your target price? Because I need more headroom. And just to show you like an egregious, I don't pay a lot of attention to this, to sell side research, but a
Yeah.
particularly egregious example of this that of course went unpunished was back when shortly after Snap went public. So MS was top left on the deal. And after that initial, cooling off period, MS picked up research coverage on it. And so, here's the target price. And there's this discounted cash flow valuation to support the target price. So I think in like year 3 or year 4, there was supposed to be this tax benefit. It was highly complex. And you see that in the DCF model. Well, after the analyst published this, I guess somebody from the company reached out and was like, "Ooh, actually, that benefit, no, it's not going to be anywhere near that large." So the MS analyst had to go into the model, sharply, significantly reduce that cash inflow from the tax benefit, but that would have dropped the overall stock price. So what did he do? He lowered the discount rate. And
Yeah.
when he lowered the discount rate, he wrote, "We're lowering our discount rate because a high discount rate connotes a level of uncertainty and risk associated with an investment. Well, because we now know more about the tax benefit, that has
Yeah.
decreased the amount of risk associated with this. So it's appropriate." Bullshit. Okay. But what's the difference between that guy and Andrew Left? Andrew didn't create this bullshit paper trail of like, well, here's my DCF and, here's my PE, analysis. That's the thing that the government, so I think, I don't want to put words in your mouth, but I think, for most of us market skeptics here, like we know that it's, these discounted cash flow models and other means of valuation for the sell side analysts are just fig leaves, to cover up a completely intellectually disingenuous exercise. And, I can't see that what Andrew did is no worse. It's just he didn't have boxes that he ticked. And that's what really bothers me about this.
Yeah, absolutely, Carson. And another angle that we haven't even talked about yet is people are giving all types of conflicted advice in the media. People go on CNBC, and if you just blindly follow people's stock picks or Jim Cramer's stock picks, I think it's very unlikely you outperform. I think there's a lot of bad advice out there for the average retail investor. The vast majority of the time, if you're following just advice you can get for free or recommendations available for free, you're probably going to lose money or at least underperform the market. The 16 stocks laid out in the indictment massively outperformed if you followed Andrew's recommendation. There was one guy, Sherwood News did an analysis, this young guy, Jack Rains, and he said, if you had purchased or shorted $100,000 of each of Left's 16 recommendations described in the indictment the day he published his report and never closed your position, you would have turned $1.6 million into $6.6 million, a 318% return, and that's three and a half times more than the S&P in terms of performance. So it's kind of like
and
a victimless crime.
Let me second that, because I did my own analysis based on the SEC complaint. And so that's more names. It's 23 names. And basically what I did was I said, okay, if Andrew said he was short, it's if you shorted at the lowest price of the day, if he said he was long, if you bought at the highest price of the day, what would your $10,000 per name, so $230,000, be worth today? And the answer I came up with, again, having, if you closed nothing out other than, say, when Twitter was acquired or some stocks that were deleted because they were bankrupt, your $230,000 today would be worth $649,000, which is a 182% overall return. That's what I calculate. Again, and that's buying at the high and selling at the low. So, and just to push I don't like terming it victimless crime. Because first of all, the statement crime is conclusory. You can look at, insider trading and, people will say that's a victimless crime. I disagree with that characterization, by the way,
Yeah.
because the problem with insider trading is it undermines integrity, or it undermines the perception of integrity in the capital markets, which then undermines the capital markets. So I don't like saying this is a victimless crime, and there's one more reason for that. I do think it's fair to ask, like, where are the victims, right? Like, again, if you blindly followed all 23 recommendations, in the SEC complaint, or 16 in the DOJ, you would have done, if you weighted it equally, you would have done very well. So I think it's fair to say, where are the victims? But the one thing on the crime element, and it's interesting because our traditional view of a criminal trial is, okay, like, the investigation began when there was a dead person, bullet holes in them. Looks like the bullets were fired by a third party. Who did this? We think it's person X. We have this trial. Okay, a crime was committed. A homicide was committed. Is person X the person who actually committed the crime here? In this case, it's inverted. Here's person X. Here's what he did. Is this a crime? And this is where I have a real problem, because the statute that they're using to try to establish criminal behavior or civil liability in the case of the SEC complaint, it's a 90-year-old statute. It does not contemplate any of the technologies that we use in our day-to-day lives. And I'll read this statute here just to it's not long. So section 240.10b-5, employment of manipulative and deceptive devices. So this is part of the Securities and Exchange Act of 34. It shall be unlawful for any person, directly or indirectly, by the use of any means or instrumentality of interstate commerce, or any of the mails, or of any facility of any national securities exchange, A, to employ any device, scheme, or artifice to defraud, B, to make any untrue statement of a material fact, or to omit to state a material fact necessary in order to make the statements made in light of the circumstances under which they were made, not misleading, or C, to engage in any act, practice, or course of business which operates or would operate as a fraud or deceit upon any person. Now, again, this is 90 years old. And I mean, it references the mails, for fuck's sake. Like, I never use the mail unless I'm dealing with the government, like, ironically, So I have a problem here in social media and how the government, can or should regulate it or legislate about it has been a huge topic of conversation. We have, there's a constant debate back and forth about, we should make it so that Facebook and other social media sites XYZ or don't ABC, and then on the other side, you've got First Amendment concerns that won't fly. Great. This debate's playing out. Congress has really done fuck all in this space. I'm talking about just in social media in general since the 1990s, Section 2, the Communications and Decency Act, I think it was.
Yeah.
And they have not touched 10b-5. Like, Congress has not touched 10b-5 to update it for the social media age. And so here you have two government agencies coming in and saying, we know it talks about the mails, but, that's Twitter too, right? Like, that's what we think it means. And we think it means you can't do X, Y, Z and you must do ABC. And it's just, where in the goddamn statute is that? And if Congress hasn't seen fit to update it for the social media age, who are you to do that? To try to establish goalposts, at the penalty to a guy potentially going away for, multiple decades of his life. I have a really big problem. I feel like it's facially an absurdity to try to take a 90-year-old statute and apply it to social media, particularly when, look, I'll allow, if you were able to transport a leading securities lawyer from the 1950s forward through time, quickly brief them. There's this thing called social media. We all talk to each other on it. You know, take a look at this. Take a look at this complaint or the indictment. What do you think? Like, I'll allow that the guy from the 1950s could look at that and say, yeah, I mean, that seems to be the type of conduct, in modern sense that the statute was intended to forbid. But then it's like, if I handed him my phone, I'm like, here, open the Twitter app, go play around on this thing and FinTwit for like, a few hours and come back and tell me what you think. And I mean, all of the people screaming on Twitter, like, this is the best thing ever. This is the most fucked up stock ever. Fuck you. Let's squeeze this, burn the shorts. I mean, all the stuff that goes on. The only difference between Andrew and these other people is that Andrew had followers. And,
Yeah.
and that's where you get back to the earlier discussion here, where we're talking about, the government, seizing on him falsely claiming to manage a fund or not take payments from funds ever. They're trying to say, well, this is how he got influence. He didn't get in, that his influence is all the product of deceit, when it's not. I mean, he has
Yeah.
followers because he's made money for people who follow his stuff.
Exactly.
But
And that's where 99% of it comes from. Maybe there's one guy who's reading Citron Capital's letters. The other thing they say is to just read from the complaint. Unbeknownst to the market, however, Left planned to capitalize on those price movements and quickly reverse his own positions in the equity, shares, and options, which he had induced readers to follow, but at prices far higher or lower than the price targets Left had pushed to his readers in the marketplace. In other words, Left bought back the stock immediately after telling readers to sell and sold stock immediately after telling his readers to buy. This fraudulent practice deceived investors. I mean, I don't think I take big issue with the term "unbeknownst to the market."
yeah,
I think I would be surprised if a lot of the just people who publish activist work don't do that. And obviously, I'm a little more well versed in the industry than maybe the average person. But I think most people who are reading these reports see the disclosure that the positions can change at any time, and it seems pretty integral to the activist short model that you do a lot of work, you put out a report, and you many times, not everybody, you trade on it that day, or you're trading options on that day. And to me, if the SEC wants to prevent that type of behavior, there should be a clear rule or a law. One thing kind of alluded towards the end of the SEC complaint is they wanted to give Andrew Left a 5-day bar from trading stocks after he publishes research, which seemed just to be kind of invented out of thin air. It's a totally new rule. It's an example of regulation by enforcement. And at least to me, it seems like it's going to have a massive, massive impact on the activist short model. And I'd be kind of curious for your views, because to me now, it seems like almost saying, if you're publishing an activist short report and trading it within 5 days, the SEC can view that as disingenuous. And
well, so okay,
especially if it doesn't hit the price target you gave.
yeah, so I don't agree with that interpretation for a couple of reasons. Number
Okay.
one, there were other short activists who were investigated, and it's been reported. Michelle Solarier just published an article in Institutional Investor, and it's been reported that other short activists received letters from the SEC stating that they closed the investigation and were recommending no actions be taken. All right. So to the extent that those short activists traded, de-risked, in a somewhat similar manner, clearly that is not what the SEC's issue is. I mean, what the SEC is saying about trading, we'll come back to the 5-day rule proposal in a second for Andrew. Clearly what the SEC is saying here is that we don't believe that Andrew did not have good faith belief in the opinions that he voiced. And these opinions, mainly the ones they're focusing on, are the price target opinions. And as evidence, or some of the evidence that he didn't have a good faith belief, he was closing his positions before they got to those purported target prices. So, they're using it as evidence that he didn't have a good faith belief in his statements. Now, in terms of the 5 days, is this? I think there are at least two questions here. Like, number one, is this will a court ever adopt this? And number two, if it were adopted in this case, is this something that would apply broadly? I'll address number two first, because I think it's analogous to the situation with Elon Musk and Twitter, right? Which, he had to agree initially to have a Twitter sitter, which he completely aggregated that part of the agreement. And the SEC, I don't think, has even tried to go after him or has had no success doing it, because you get into this realm, which his attorneys have argued very quickly, of free speech. So, even if the court said, and I really doubt a court would say, or that it would stand on appeal, that there's some time period which will require Andrew to hold his positions after publishing in some form, that would be one of those things. It's certainly when the SEC entered into that settlement with Elon Musk, that was not a requirement that other public company CEOs, have Twitter sitters. I think for the SEC, they're saying, well, there are rules that are, there that Elon Musk violated, and to ensure he doesn't violate them again, he'll have a Twitter sitter. So I would read this as being, any judicial decision here as being limited to Andrew only. Now, let's get to whether they'll win on that. This could go a lot of directions, but I'm gonna point out one way in which take me back to my 3 years of legal scholarship. Putting me in that mode where I think this is kind of interesting. So in the U.S. with the First Amendment, the vast majority of short activists, when we publish, and this would also include yourself, even though you don't take short positions.
And I don't necessarily consider myself a short activist, right, Carson. Right. I've never
Correct.
given a price target. It never explicitly says sell. Right. I kind of view it as early stage research.
So when I said this includes you, what I'm about to say applies to you, even though, as I pointed out, you're not a short activist in the sense that you don't take positions. But this applies equally to you, to me, to just about everybody who is publishing negative commentary about these stocks, especially when what we publish is really about deception. It's usually about deception on the part of the management, business practices that are harmful to society, etc. That is core First Amendment protected speech, and there are several decisions in various jurisdictions in recent years that have recognized it as such, and I've been involved in a couple of them. And interestingly, Andrew maybe had the first such decision. It was an unpublished decision from California State Court, because Andrew was sued a number of years ago, and he countersued under the California anti-SLAPP statute. And what the court dismissed the suit under the anti-SLAPP, awarded Andrew attorneys or reasonable legal costs. And in the dicta, the court talked about how it's important, or what Andrew was doing was commenting on matter of public importance, and it's the functioning of the capital markets, free from deceit, free from fraud, that sort of thing. So when you're speaking about the deleterious business or reporting practices of a company, I think it's clear that it has implications that are broader than just, is this a good stock to own or not? You're speaking to more than just the investors in that company. Now, that I would say is separate from, say, sell-side investment banking research, or where somebody's analyzing fundamentals and saying, I think the stock goes up or I think the stock goes down because the new product is yada, yada, yada. That's not a matter of public concern. That's speaking to the investors in that company or potential investors in that company only. So that is, to me, what they call commercial speech. And so commercial speech is entitled to fewer protections than speech regarding matters of public concern, which is entitled to really the highest level of protection under the First
Mm-hmm.
Amendment. So the interesting thing here, what I'm getting at is when you look at the complaint and the indictment, you have two categories of speech here potentially. You have the
Mm-hmm.
matters of public concern on the short side, when he's calling something a fraud or a scam. And then you have Tesla is going to, kill it in earnings, and that's commercial speech. So when you get to that core First Amendment protected speech, and this is, to the 5-day rule, there have obviously been some vocal critics in recent years about the practice of publishing a short report and de-risking. And and also, the idea, the professor who's an academic fraud named Josh Mitz submitted a rule proposal to the SEC that short activists be required to hold their positions for a certain period after publishing on a company. And, it's kind of amazing for a law professor that he would be unaware of the First Amendment implications of this. But the First Amendment implications of it are as follows. Okay, I'm short XYZ, you're short XYZ.
Mm-hmm.
I've got a report ready to publish on XYZ. I publish it on XYZ. Okay, it's exposing, some wrongdoing, again, matter of public concern. So I publish it. You, who did not publish it, who did not exercise your First Amendment right to speak, you are permitted to cover your position at any time. However, under this view, for exercising my First Amendment right to publish core First Amendment protected speech, I have a burden now that nobody else in the marketplace does. I may not trade my stock under this rule for a specified period of time that applies to nobody else. So when it comes to the matters of public concern in the short reports, I think that there's no way a court would ever let a rule like that stand. But it gets interesting when you think about commercial speech. But then that just becomes a big mess for government lawyers, I think, to try to, and also for Andrew, if his defense goes this route, to just get into like, well, what's commercial speech? What's core First Amendment protected speech? How may we regulate commercial speech in this context? And then when you zoom out and you take a look at all of Twitter and just, in social media, and now they're trying to organize short squeezes on social media, or, and people are talking about buying stocks just because they're going up, which it's kind of funny. Like some of the views of, some of the prosecutions, or criticisms of, for purported stock manipulation, when you go to this, like, do you have a good faith belief that the stock should be worth more than where it's trading right now? There's embedded in this, like, this Pollyanna-ish assumption that everybody, from Joe the plumber to Dan Loeb, is sitting there looking at the financials and with spreadsheets and, like running
Mm-hmm.
regression analyses, like, what do I think this is worth? And, whereas if you look at algo traders, like the vast majority of non-HFT algos are either saying, I think that this is going to revert to the mean, or because it's going up or down, it's going to go up or down more, and it's a momentum, it's a following algo. There's no fundamental analysis there at all. But, when you get into some of the, and this is, I think, inherent in the complaint and indictment against Andrew, there's like this view that, you have to have some fundamental, some fundamental opinion of the company and its business, as opposed to, and then, like, I think this is worthy of conversation as well, in terms of, how Andrew is different from, just about everybody else in the short activism field. Trading, right? Like, Andrew is a trader more so than anybody else,
Yes, very
and
much so.
I think he's made a lot of his money outside of his, his public pronouncements on stocks. It's like, if he, if there are more buyers than sellers, it goes up. So he's, if he thinks there are going to be more buyers than sellers, even like the actual value of the company is irrelevant. And so I think you're almost getting into this, I think the SEC and DOJ almost get into this, it's like a slippery slope without, I don't think there's too much distance down there before you start arguing or start asking whether we should be, indicting computers for, trading and momentum names, or mean reversion without any belief, without having, try to calculate the underlying, like the fundamental or intrinsic value of what they're trading.
Yeah, it's kind of funny to think that if Andrew didn't provide any price targets and provided even less analysis than he did, if he just went full Keith Gill, Roaring Kitty, and was tweeting out memes, about his opinions, I think people would still say, look, Andrew Left has a reputation for outperforming. I want to buy what he does. I don't think you'd be able to even make a case against him that is like, in some ways you get punished for sharing price targets and for sharing analysis, because then they can claim it's ingenuine. Versus if you're just tweeting out memes, it seems like that's kind of allowed. And that seems a little backwards to me. Another issue with this case is when you look at the specific incidences, sometimes it's just not as extreme as I think the SEC or DOJ makes it out to be. Off the top of my head, I know he called Palantir a casino stock. And if you call something a casino stock, you almost are expected to trade in and out of it really fast. It would be almost weird if you didn't. One of the weakest points of the indictment was the SEC complaint was about Vuzi, where Andrew tweeted in December 2020, quote, getting emails about shorting Vuzi. No way we would short this flyer. Small cap with the story that is tied to 5G, Amazon plug, and COVID. There has to be easier pickings, still doing research, risk reward easier on other high flyers. It's like, that's not a long recommendation. That's not a price target. That doesn't even say he's long. If anything, it's just caution, let's not short this. And somehow the SEC construes that as a long recommendation, gets upset when he doesn't delete that tweet after he sells his stock a few days later. He says he's still doing research. This isn't a recommendation in any ways. This is just like top of mind, sharing thoughts. I get in things, I get out of things. People know, that's the bizarre thing to me. It's not like Andrew, generally speaking, holds himself out to say, I hold my positions for a year or two. Everyone understands he's a trader. Everyone understands he's in and out of things. He's more or less explicitly saying it. It's sometimes he goes long something and then short it, and short it then long it. I mean, yeah. No, it's like they're trying to say he's presenting this fake picture when I think everybody knows this is how he and other, activist short operates. And if anything, I think it's people, generally these anonymous activist shorts who are doing balance sheet deals, where I think that's less known to the public how aggressively people trade in and out intraday or within a few days. And to me, it kind of begs the question, do you think we need more disclosure around how activist shorts trade around reports? And do you think there should be any regulation around trading around an activist short report, day of publication around it? Or should it just be, you can do whatever you want?
Okay. Well, so I'm going to address everything you just said with, looking kind of from one perspective here. Okay. Yeah. So the theory that underlies the First Amendment is the marketplace of ideas. And in the marketplace of ideas, the view is that we don't need to be protected from ideas or speech generally. That the good ones are going to float to the top, the bad ones are going to sink to the bottom. And that is also, so when you look at this attempt to enforce against Andrew, I think it's, and in so many ways, government has, I think, infantilized investors and infantilized market participants. Yeah. But I feel like it's further to that. It's, he created this false following by, because he was claiming that he was a fund manager, as opposed to, no, the marketplace of ideas, in the marketplace of ideas, Andrew was a big winner. He got a big following because he, in the marketplace of ideas, has judged him based on his track record and, like what he's written as someone whose ideas have high value versus almost anybody else in the space. I mean, I think Andrew has more Twitter followers than anybody else in the short activist space. I mean, I'd argue
Mhm.
some portion of that is because there's a bigger market for people who want long ideas than short ideas.
Yeah.
But even so, okay, like, the the marketplace of ideas is functioning. That's why he has his his influence. So no, I don't think that there should be a rule or there needs to be a rule because the vast majority of short activists, like this is what I tell people, vast majority of short activists or people who've tried it, suck and they fail and they go out of business very quickly. They're screaming on Seeking Alpha about some nano cap piece of shit. Like, this is the worst thing ever. Nobody believes them, right?
Mhm.
So you go away. So the marketplace of ideas, after somebody's put out a few publications, the marketplace of ideas is functioning. And it's basically saying, based on the number of followers or, how much of a reaction somebody's analysis generates, they're saying like, this is the pecking order. And so if you're credible, you earned it. And, what's the penalty for fucking around? Penalty for fucking around and doing bad work is you lose influence and you lose your following. And, that kind of goes to this, this question that you brought up earlier. It's like, well, what was generally believed about Andrew and what was not? Look, Andrew
Mhm.
had no shortage of vitriol directed toward him by people who are generally supportive of short activists. I mean, frequently he was called Shitron on social media, right? Like, it's so the marketplace of ideas was functioning, and if it's important to a trader or an investor, what have you, that the person speaking, look, the only reasons that anybody discloses whether they have a position is because that's pretty well established. Now, I just read the text of 10b-5. It's not stated in 10b-5 expressly, but, we know from decades of jurisprudence in this space, I mean, all the lawyers know that, if you're long something and you're going to talk it up, you need to say I'm long. If you're short, that's the only reason that anybody discloses that in the first place is because the law says they have to. So that, so that what I say is not viewed necessarily in the same way as what you say, right? Because people are like, well, Edwin's not going to, directly make more money if the stock goes down in this case, whereas, Carson will. That's what an investor needs to, to understand. I mean, I think that's fair. Do we need to lash ourselves to these positions? I mean, what would have happened to Gabriel Grego with Casaba, which, by the way,
Yeah.
he's 100% right. He's 100% right. And that stock
Yeah.
immediately soared. I think, more like 80% right after his report. Like, why should a guy who's right be put in a position where it's like, you've got two choices at this moment. You can go out of business or you can break the law.
Yeah. It's harmful to force shorts to hold their position for 5 days because you can kind of be squeezed out of your position. I'm extremely against
Oh,
this
okay.
5 day rule. I think it's completely arbitrary. I think it creates all these weird situations where sometimes you say something one day and you realize you're wrong the next, and you can't say that for 5 days, or you need to wait to correct yourself. I think a lot of times long activists, when they release a new position on the long side, they'll buy call options knowing the stock is going to spike. I mean,
Yeah.
that's trading within 5 days.
I,
You're saying you're
I
really
mean, like,
excited and you're selling calls. It's
I
like
mean, they need to
there's
they need to cancel the Iverson and Robinhood conferences if this were a rule, right? Like, I mean, come on, you know.
yeah, it just and it disincentivizes smart people from sharing their ideas, and you get more like kind of nonsense on. You get just more bad, advice. You get more bad stuff. I'm kind of curious if you think this will change the activist short landscape at all. It seems like you and I disagree a little reading this, how much it could apply to activist short sellers. Do you think this dissuades people from providing price targets? do you think this dissuades people from doing balance sheet deals? And do you think this dissuades people from being active as short sellers at all, or publishing, or maybe publishing on weaker cases? Do you see any changes coming from this, or do you
Well,
think it's just going to be business as usual?
okay. I mean, I guess I can't really, I can't predict how other people are going to react, right?
Yeah.
But I think if you actually, read these things closely, um, so I mean, if you, I think if you actually think about this, then I don't think the vast majority of us need to change our business practices. So, number one, like I said before, there were short activists who were investigated and who've received letters stating that there are going to be no actions taken. And what differentiated Andrew probably from the rest of that group is Andrew's very quick in doing his research. Okay, so he obviously leans significantly on third parties, which I don't think that's wrong. I mean, if I'm a fund manager and I hire analysts, I can't do all their work. I can't check all their work. I am relying on them to some extent. And P.S., when I'm managing outside capital, I have a fiduciary duty to those investors. I do not have a fiduciary duty to the general public. So if it's okay for me to rely on work done by people whom I vetted to some extent when I have a fiduciary duty, I don't see how you can say, well, there's a higher standard if you're going to be talking about things publicly, but relying on the work that somebody else did, right? If you know the person, you trust the person, you think they're good at it. I mean, I'm not saying that I think that's the ideal approach, but I don't think that Andrew doing that should be illegal or is illegal. But what effectively, the case here is that he didn't do his own work, and that the price targets that he established don't have a good faith basis, that they're just designed for shock value as opposed to any belief. And, one of the ways that we're going to prove that as government is to show that he traded out of these positions long before the target prices were reached. So if you're a short activist and you do a significant amount of your own work and you're not just putting stuff out 90 minutes after somebody sends it to you, then I think that meaningfully, I think that differentiates you from the conduct that the SEC and DOJ are concerned with here. That's number one. Number two, vast majority of short activists don't put target prices on their work. Because I mean, especially when you're,
I don't know if I necessarily agree with that, Carson. It seems like most of the time there's, at least from when I read, there's like a price target.
Yeah, maybe you're reading, more guys than I am. I mean, but I actually don't read that much of other guys' stuff. It's pretty rare, but most of the stuff I do see doesn't have a price target. And part of the, like the big point that I make, I mean, so many
Yeah.
times when I've, said, when we've been short something, I've been asked by, media, like, well, what's your target price? Like, look, there's a problem with the information that the company disseminates. Okay. The financials have issues in, certain ways. Okay. We can see some of it. I don't know what the entire body of problems is. Like a lot of when we're on the outside and we're trying to figure out what's going on. I mean, it's really the cockroach theory. Like we'll see some portion of the cockroaches. So my
Mhm.
view has generally been, that, and this isn't the case for all theses, but if you're bread and butter short activist thesis, it's like, look, if you're attacking the company's reporting and transparency and financials, you can't tell what it's worth because you don't have good information. So I think it's asinine from that perspective to put a price target, on it. I mean, if if it's and it's kind of funny, like, sometimes, especially with the context of China names, I'll call something a zero, or I've even called something a
Yeah.
king zero. Now, do I think that means that they'll trade at zero? No, because, like, I mean, I've joked sometimes on Twitter, like, 700 million is the new zero, because it's like you'll see these things that are like completely bombed out frauds that still have market caps. I mean, Luckin Coffee, which has been, was admitted to being had admitted to being a fraud. It never went away. It just added an extra letter to its ticker, and it's got a multi-billion market cap now. Like, right? But if you ask me, should you ever let these motherfuckers anywhere near like a U.S. domiciled exchange? No, fuck them. Like, they lost that right. I think I would pay zero for that stock. Like, okay, if you gave me certificates, cool. Maybe I'd pay a few cents. But that's, but that's really, but that's a different question than where will the market take the stock? And who knows? Like, who knows? And so it's just, again, the whole exercise in target prices, the place where that's practiced the most is the sell side. And as we already covered, that's just disingenuous and arbitrary at best.
Yeah, absolutely. And just on the topic, Carson, here of language, free speech, sell side, pumping stuff. One of the most bizarre parts of the SEC complaint, and this is some of it's repeated in the DOJ indictment. It reads, left often drafted Citron researchers short publications in a sensationalist expose style and strongly encouraged readers to sell the stock of the target company. These publications would often declare a company a fraud, scam, scheme, and use powerful imagery and language, such as calling the company the Harvey Weinstein of social media, uninvestable, and declaring that investors have been warned, wait until the Senate finds what Citron has published, and warning the SEC should halt the stock. Right away, I was just curious, like, which stocks Andrew, referred to in that way. And if you just look at it, like in the case where he says the SEC should halt this stock, that was Inovio Pharmaceuticals, which was mooning on some COVID treatment that didn't pan out and ended up falling 95%. So he was kind of right. The SEC should have halted the stock.
No, Inovio is such a piece of garbage. I mean,
and then in the other cases,
at present, but it is such
he calls Kronos a fraud, and the SEC later finds it to be committing fraud. He calls companies uninvestable. I think he said Roku was uninvestable because of changes in the technology landscape. To me, that's not inflammatory. That's just reasonable. You're just saying we just need more information. I don't have enough information to investors don't have enough to really invest in the company because the situation isn't, fully panned out yet. It seems so bizarre to me, especially when, Citron, the slogan is cautious investing to all. There's, fairly lengthy disclosures in every report. Then you got sell side where you can pump it up to infinity. He says to some situations uninvestable. That's terrible and sensationalistic. Kathy Wood says Tesla is worth 20x its current stock price, or gives huge price targets, and that's totally fine. But calling something uninvestable is bad. Calling a fraud is bad. Saying the SEC should halt the stock that's being promotional and should have been halted is bad. It's so backwards.
Well, yeah, and I think when the SEC and DOJ talk about the inflammatory language, I think they're saying that he made further statements that he didn't. It's called bad faith statements when he used this inflammatory language. Like, he wouldn't ever normally speak that way about these companies, and it was just designed to provoke a reaction like the out of range price targets were. And it's like, look, number one, so this gets into a very dangerous area. Okay. Like, are there going to be certain cartoons that are maybe, too acerbic that we should disallow because of the language is inflammatory? Here's the thing. Like, even if Andrew sat back and said, it's such a crowded information environment, and especially during the Trump years, right? Like, that's something that I noticed it's just the information environment became so crazy because you got like the president of the United States out there like on Twitter every day, like, either slamming companies or Rosie O'Donnell for being fat, and it's such a crowded information environment. So even if you said, hey, Andrew's just being really craven here, and he's choosing words and language that are designed to attract attention, against this backdrop where the whole fucking world is insane and the president of the United States, like created this whole definition of something called shithole countries. Even if you said that Andrew's being craven and, not, that this isn't how he really thinks or speaks, I'd say that is just an impermissible attempt to regulate expression. You can't do that. But here's the kicker. If you ever met Andrew, it's absolutely how he speaks. I mean, like that's the best part. I mean, one of favorite things Andrew, my favorite comments from Andrew ever. I think this was, a comment he made in like 2018 when I saw him, and I forget, whatever, like stocks were soaring, like Netflix was soaring, and this and that at the time, and he's like, this is all so ridiculous. This is all so overhyped, right? I mean, like, just because it's new. Okay, but think about it. Like, will Netflix change your life the way that like the toilet changed lives? Like, no fucking way. It's like, but imagine if like you were the guy who like invented the toilet. Like, what kind of like, you don't have to like throw your shit out the window anymore. Like, what kind of massive valuation would you see in your stock? I mean, he's just going on like this, and he is hilarious. Okay, he writes the way he speaks, which is the way he thinks, and and that's an impermissible, under the First Amendment, attempt to police means of expression and basically, limit the vocabulary that people may use when they are discussing matters of public concern, like, which in this case are the integrity of the financial markets. So that's just, I mean, I think at the end of the day, what they're trying to do is they're trying to use that to color the jury's perceptions of Andrew and, and make him, make them believe he's craven, but it's really the charged conduct here is the price targets.
Yeah, I've always felt Andrew's very genuine. Andrew's Andrew, and if he started buttoning up and acting like other Wall Street, then that would be ingenuine.
Yeah, then you run. And you're like, dude,
if you could have somebody just make a model every time with a more extreme price target, and it's like,
yeah, it would
be silly. So,
Carson, I have to say, I mean, I had a job once, when I was out of college, and in this job we had to make investment banking decisions based on a risk-adjusted return on capital, RAROC. And I, as the air quotes analyst, would drop in the numbers. And if the RAROC didn't hit the hurdle, I had an MD over my shoulder saying, all right, let's, boost year 3 revenue by 3%, increase the margins by 50 basis points, and until we got to the answer we wanted. All right. That's Andrew's sin here, apparently, is he didn't do that.
Mm-hmm. Carson, as we come towards the end here, just looking out big picture, let's say we were kings of the world. What would you want the outcome in this case to be? What would you want regulators to do? What would be your ideal world, not just with this case, but like the regulatory environment for activist short sellers? What would you like to see happen? You've got all the power in the world.
Well, I mean, there are a few things that I see as kind of like sick ironies here, because I think most of us in this space have we've lamented the lack of enforcement against corporates. And, I think it was kind of a rallying cry for us when Jesse Eisinger published a book called The Chicken Shit Club. And in that book, he made this case that the government doesn't take hard cases because they don't want to lose, or the individuals don't want to lose. But, and I think a lot of us, have talked about that publicly, and how that's a real problem. I mean, when Jim Chanos, repeatedly calls this the golden age of fraud, I think, most of us are in agreement, because the way we look at it, it's like, the adults are not in the room. Like, nobody's policing the just over the top outlandish shit that goes on. At the same time, you have markets distorted by, passive investing. I mean, this is becoming a real problem for the fragility of markets. You've got, the government bailing out, overly indebted companies and private equity firms because, they took on too much debt when it was cheap. And so they need cheaper debt so that they don't destroy society. Um, you have a lot of problems here. And, I guess I would start with, I definitely would want to see much more of a focus on corporate enforcement, but I also think that and I don't really know how this is going to happen because I'm sort of arguing against my whole view as to taking 10b-5 as it's written and applying it in this situation. But, there's so much of what we see, from my chair, what I see is that there are lots of people who routinely violate the spirit of the rules and the laws without actually crossing the line legally because they're just really well lawyered. And I've often asked myself whether there's a regime that would work where we looked at the spirit as opposed to the letter. And look, I think that would address, a good portion of the corporate, problems that we see. But then, yes, is that fair when you look at a situation like Andrew's and they're, taking a statute that expressly mentions, the male and applying it to him and, effectively saying his conduct violates the spirit? I don't know. I mean, one other thing, though, that was kind of interesting that this caused me to think about, a few weeks before Andrew, was indicted and sued by the SEC, I was having a conversation with a friend of mine who's a former assistant U.S. attorney and, also a former investment banker, who's now a trader. And he's a traditional, like, Reagan Republican guy, Federalist Society type. And we were talking about the SEC, and he said, Congress should just abolish that agency, should just abolish the SEC. Rulemaking should be done by Treasury, and all investigations and enforcement should be done by justice. And I thought about that. I'm like, I mean, that would seem to make sense. Like, I don't know why we need an additional 3-letter agency here. But then when I saw with Andrew, what happened, I mean, on the same day, he's indicted and he's sued by the SEC. These are going to be 2 separate trials. They will likely not occur on the same timeline either. So one of these agencies is going to get a look at his defense before going to trial. So you're making this guy fight a 2-front war over the same set of facts and the same claimed legal violation.
Yeah.
Like, this is just coercion. Like, Andrew has the resources to do it, but he's probably, I mean, I would guess, looking at $10 million a trial. So, that second trial, I think, is probably going to tax him an additional $10. And like I said, somebody's going to get a look at his defense and have an advantage. So I just think that there's something inequitable about that system. And I hadn't pondered this before, but when you have 2 separate government agencies going after you for effectively the exact same thing, I don't think that accords with just a philosophical version of due process.
And Carson, one point we haven't even brought up is we haven't even heard Andrew's defense yet. And obviously he's going to say that for trial. And the fact that we can read the SEC complaint and DOJ indictment and just so many holes and things that don't make sense and misleading allegations, just reading their one-sided narrative. And there's all these problems and deficiencies here. It kind of reminds me of when you have a friend complain about a situation to you and their one-sided narrative doesn't even make them look good. Then it's really bad. If things don't make sense, it's really bad. So we haven't even heard the other side. Just the very one-sided thing is there's just so many slanted. It makes me just, the huge number of weak points makes me very much doubt the few, stronger points in the case.
But this is also where we get to this, you don't have to testify in your own defense. And he certainly may refuse to testify. I think he may legally refuse to testify, in the SEC action. And he certainly may take the Fifth Amendment if he does in that. But the point that I'm making here is, if Andrew is saying, look, I wrote, $5 and then $4.50, but ultimately $3.50, it's because I was looking at the valuations on all these things. I saw how they were sliding. I thought about the flows into the space and what I'm seeing here in terms of demand for the ETFs and blah, blah, blah. And, at the last second, I thought about this and realized, no, I think actually 350 is the right number. I mean, something like that, would be a plausible explanation. But the problem is because he doesn't have that fig leaf that we talked about earlier, the bullshit DCF or, comp analysis that you find in a sell side report, he doesn't get to put that forward unless he testifies, I think.
Mm-hmm.
And that's just, if you ask going back to your question about how does this change after the short selling, I think maybe what it says, if you don't have a lot of a paper trail for your work, then maybe you should. I think there are a number of short activists who also delete a lot of the information, a lot of their research at the time they publish, the internal stuff, because, if they're sued, they don't want to have to pay for the cost of lawyers to review it in discovery. But, when it comes to the regulatory side of things, maybe the lesson is, if you have that stuff, it's going to look a lot better because it's going to make it hard for anybody to argue that you didn't have a good faith belief in what you were saying.
Very fair. I didn't know the thing about people deleting internal work. That's interesting.
I get it. Like we can't because, but we're fully registered SEC investment advisors. We have to keep our shit for 7 years. And I got to tell you, that like every time, we get a subpoena, we get a lot of non-party subpoenas as well. And, we get sued if we have to produce stuff. You're just paying these lawyers to review this stuff, which it's such a racket. It's like you pay the lawyers to review the stuff you're producing. And why? It's not like they're going to go like, oh shit, this is really bad. Let me put it in my pocket and not turn it over. And then if you're ever going to be deposed, you're going to pay for them to reread the shit that they already read one time. And then you're going to pay for them to like read it to you when you're preparing for your deposition, and it's just, so if there are guys who say like, hey, I want to delete all this because, it's a litigious business and I don't want to, pay the societal tax that the legal system imposes on us, especially when you're in short activism, like I can understand that. But yeah, when it comes to the regulatory side of things, it can help you, cover your ass the way that everybody who's really well lawyered, on the buy side or sell side seems to do.
Fair enough. To loop back to the question I asked you, Carson, about what you would like to see changed,
yeah, I dodged that, right? I'd like to see more enforcement against companies. I'd be willing to entertain the idea of consolidating all investigation and enforcement in one agency so that you don't have these ridiculous two-front wars, one's civil, one's criminal. Yeah, those are some things. That's a matter of fairness. And I'll say this, like I believed Bill Huang was a manipulator. But I believe that just from GSX. But there were certain things that happened in the courtroom and in the trial that I thought were unfair. And, one of the things that I also would change is, the government's and I guess litigants in general reliance on academics. And, society has a really warped relationship with academia. The fact of the matter is that to get published in most fields today, you have to be saying something pretty far outside the norm because, everything that's right has all more or less already been published. Like in something that moves quickly like technology, that's not true. But a lot of the rest of society, you have to be more and more outside the mainstream to get published. And we don't understand that. And the legal system doesn't understand that. The legal system gives particular emphasis to academics, and it really should not. And they give very little emphasis to practitioners. So my understanding in a trial is that, if you call somebody who's been a trader for like 28 years and, you say, hey, what happened here? That the legal system de-emphasizes that in favor of, the ever truth-seeking academic. And the SEC in the Bill Huang trial brought in their own in-house academic, somebody with a PhD. And Huang's defense attorney asked her, have you ever traded $50 million worth of stock at one time? And she said no. And then the judge cut the questioning off. I'm sure, if you ask her if you ever played Monopoly, though, she'd say yes. And ha, ha, ha. And your jury laughed. It's like, no, there was an interesting point here because there's a big difference. Like a lot of things look one way from the outside, but when you get
Yeah.
to the inside, it's quite different. So I would like to see a de-emphasis on academics in the legal system, and emphasis on practitioners in the legal system. And something else that I've been calling for a long time is the vitiation of attorney-client privilege for internal investigations that companies carry out. Like, to me, that's the biggest joke, right? The company, maybe they're accused by an activist short seller, or there's some other reason. They have an internal investigation. They never have to say what they found, right? It's all protected by the veil of attorney-client privilege.
Mhm.
They'll let you know what they want to let you know. They'll issue a press release. And that's why it's often, found no evidence to support the allegation that. Where did you
Yeah.
look? Like, well, where didn't you look? So I'd like to see that attorney-client privilege eliminated, because it's kind of weird in the sense that, you're keeping that information from the owners of the company itself. It's like, we're going to check your body out for cancer, but we're not going to let your brain know what we found. So I think that needs to go. Yeah. The final thing is, we're a little far afield here, but auditors, this idea that they, ring fence liability, you have these global audit, air quotes, networks, right? Networks of member firms, as they call them. And, people and money move freely throughout until there's a problem. And when there's an audit failure, it's like, whoa, this isn't you can't go after Deloitte Global here. This was Deloitte Mumbai. That was their fault. That
Yeah.
liability is ring fence. It's legal fiction. It's total bullshit, but they get away with it all the time. So those are things that I think would definitely make corporate reporting more honest, and I think would make enforcement fairer. Yeah. But other than that, like, no matter how you cut it, guys saying negative things in the market are always going to be hated. So there we are.
Yeah. Very fair, Carson. Maybe if
Cool.
I were to take a stab at that question, I would
Yeah.
say
Well,
I'd
okay. Let
want.
me ask you. Okay. So what would you do then?
What would I do if I'm king of the world? I would want to see a lot more individual accountability rather than corporations. You find a corporation, nothing changes. You find individuals, I think that behavior changes. You tell a CEO, hey, if you do this bad thing or this gray area thing that could increase profits, the CEO will say, well, I'm a fiduciary. I need to maximize shareholder value. Let's do it and see what the fine is. If you say, well, your name could be in a press release, you could be personally fined. You could be barred for a year. I think the shift really happens. Or no, we're high integrity, got morals, we would never do such a thing. So I think finding individuals create bad conduct, not corporations. That's something I'd like to see. Even if the fines are less, find the individual, hurt the individual, hold them accountable. I personally, you and I might see it a little differently. I would just love explicit regulatory clarity around the activist short model, trading around reports, and using balance sheet partners. I think the SEC just clearly state you can trade whatever you want. You can use a third party. You can be in and out in a day. You can, just a little more clarity that that's 100% okay. Because I personally feel like it's a little bit of a gray zone, and then they use that to go after the bad actors they perceive. And then the final thing is, in the short world, I would just love to understand what Harry Markopoulos did with GE is okay. Here's a guy, he comes out of nowhere, he has a huge report, huge scandalous allegations, very little of it, any of it's true, sends the stock down 12% in a day, probably made millions, if not tens of millions of dollars, and the hedge fund partner. That to me is like the most, it causes retirees to lose money. It's a distraction for the company. This is the most harmful conduct imaginable, and the DOJ is defending it. So
Well,
I would love to understand how that's not a crime.
I mean, look, I would, I think it's one thing to ask, how is that not a crime? Or it's another thing to ask, well, if Andrew's conduct is criminal, how is Markopoulos' conduct not criminal? I mean, I don't think what Markopoulos did is criminal. I think he just showed he's bad at this, right? And to be fair,
And he made $20 million being bad at this and being disingenuous.
but to be
That's
yeah, but to be fair, okay, I mean, there are few companies that were more complex to analyze, at least at that moment in time, than GE was. And I've come to know Andy Fastow a little bit, and it's funny because he recall in 2000, he was named like CFO of the year by CFO magazine.
Yeah.
2001, the company filed for bankruptcy. But what he told me was, he said, at Enron, we always looked at GE as the gold standard for financial engineering. So like everything we did, we were modeling it on GE. And so then when we came up with the Raptors, we started getting we got calls from a couple of people or some couple of our bankers who said, hey, the guys at GE really want to talk to you. And Andy is like, it was such a proud moment because I was like, wow, they want to talk to you to understand how you did this. He's like, it was such a proud moment because it's like, the guys we had looked up to for all these years were now looking at us and saying, how did you do that? So, like knowing that, I mean, first of all, Enron wasn't like the biggest fraud ever. Like there was a little bit at Enron that was a fraud. There was just a lot that was legally, financially engineered with a lot of debt. I mean, that's my view on it. So whenever people pull out the biggest, fraud or whatever since Enron, like I think either they don't understand Enron or that statement is in and of itself kind of misleading because that the public thinks Enron was a massive fraud. It was a massive company that had some fraud, but most people don't get that. But look, it was hard to analyze, and like that. I found that when short activists mess up, I think it's because they have unknown unknowns. All right, so like if you look at Andrew in Hong Kong with Evergrande back in I think he published in 2011 or 2012, and he was ultimately he agreed to a settlement in Hong Kong. Look, he was obviously directionally correct, right? I mean, look, everybody who knew that stock knew that it was fucked. But the thing is, there were statements that were wrong because he didn't know what he didn't know. Okay, like I had taken a look at that thing in the day with my team. I had PRC qualified attorney, I had PRC qualified accountant on the team. I had practiced law in China, and like everybody else on the team knew China business intimately. And we're like, like there could be other reasons for this, but you wouldn't be able to think of those reasons unless you understood the law in China or the implementation regulations for that law. And so Andrew didn't, he was operating with unknown unknowns. I think when guys fuck up, it's because they have unknown unknowns. And I think Markopoulos fucked up because of unknown unknowns. Now, like, I think the key, what I always tell people who are interested in doing this, one of the things I always say is like, you have to do your damnedest to make your unknown unknowns into known unknowns and then, try to address them. But you got to have a sense from when you're out over your skis. And I think, frankly, anybody who was trying to look at GE was such a black box, you're out over your skis. So, was it bad faith? I think he just didn't know he was out over his skis. Did he swing harder at it than he would have if there wasn't a lot of money potentially involved? Yeah, okay. Does the fact that somebody who had more money than he did and was able to put on a position that he could never be able to put on, pay him a percentage of profits, does that make it a problem? No. Because effectively if you, go after the balance sheet provision business, you're basically saying like the only people who can be short activists are people who have a lot of money already. And so if you don't have a lot of money already, then, you're too poor to be in this game, fuck off. Like that can't be the answer.
Yeah. Well, we covered a lot, Carson. In 90 minutes, this is a fun conversation.
Yeah, definitely. Well, thanks for joining, Edwin, and we'll see how this plays out.
Absolutely. Hopefully, this was helpful for listeners.
Yeah, hope so.